BHP Group, ticker BHP, is currently trading at $60.90, and over the past 5 years, the company is up by 36.55%, and over the past 6 months, the company is down by 1.85%. Now, BHP is the second largest mining company in the world, and even though a third of their income comes from mining iron ore, they are also invested into mining copper, nickel, coal, and potash. Now, most of these ores are crucial for the creation of everyday objects, computers, refrigerators, phones, you name it. Every single product you use daily contains either copper, iron, or nickel, or all three of them combined. And therefore it is no surprise that when we jump to our stock valuation spreadsheets, the analysts have a target price of $82 by the end of 2023, which is almost a 33% upside from the current trading price. Now we can also see that the dividend yield of BHP is sitting at 8.7% with a dividend payout of $5.30 every single year for every single share. BHP also has a trading payout ratio of almost 80%, which is slightly higher than I like to see. Now if we have a look at the beta of BHP, it is currently sitting at about 0.88, which means that you will see slightly less volatility with this company than you would with the overall market. Now let's value the company in a bit more depth, and to do this, we will jump over to the 9-pillar analysis. And for those of you who are new to this channel, the 9-pillar analysis is something we love to use to decide whether a company is worth investing into, and it consists of the 9 metrics crucial when valuing a business you want to buy as an investor. Now the first metric we want to look at is the 5-year PE ratio, and we want this to be sitting below 22.5, which indicates that the company is undervalued compared to what they are earning. BHP's PE ratio is currently sitting at about 12.79, which means that they might be undervalued compared to their earnings. We also want their 5-year profit margin to be above 10%. BHP's is currently sitting at 52%, so that is in the green. And we also want there to be net income, revenue, and free cash flow growth over the past 5 years, which indicates that the business is growing. Now, as a value investor, I also want there to be decrease in shares outstanding. And this allows me to own a higher percentage of the company as there are less shares outstanding in the overall market. Now the next metric I look at, and probably the most important one, is the long-term liabilities of the 5-year free cash flow negative dividends. This allows you to see whether a company generates enough free cash flow to pay off all their long-term liabilities while paying out their current dividend. Now BHP is currently sitting at 0.88, which means that they would be capable of paying off all their long-term liabilities in about 4 to 5 years while paying out their current dividend. Now the 8th pillar is the price to free cash flow of the past 5 years to be sitting below 20, and this is very similar to the first pillar, but instead of earnings we use free cash flow. Now this pillar is sitting in the green for BHP, so we can move to the 9th pillar, which is consecutive dividend growth. And as a value dividend investor, you always want your companies to have consecutive dividend growth because that is what grows your investments the most. Now we can move to finding the intrinsic value of BHP, and first we are going to use the grams formula revised. Here we take the earnings per share of the company, the base PE at 7, the 5-year growth estimate, the growth rate multiplier, the average yield on AA Corporation bonds, and we divide all this by the current yield on AA Corporation bonds. You can see the formula right here, and through this formula we get an intrinsic value of $63.70. Which is 4% higher than the current trading price of the company, and if we were to plug in a margin of safety of 10%, the acceptable buy price would be sitting at $57.33. Now moving to the next valuation model, the discounted cash flow model, we take the free cash flow of the past 10 years or so and calculate the average growth rate to be sitting at 122% annually. Now the analysts predict a negative 20% for the next 5 years. Therefore, I calculated a growth rate of about 6% annually. I plugged in an initial growth number of $14.3 billion, and using our calculated growth rate, I calculated the future free cash flow over the next 10 years or so. Now moving on with the valuation, we take the discount rate at 8% and calculate the present value of that future free cash flow. We then sum that all up, add any cash and cash equivalents, subtract total debt, and get an equity value, which we divide by the shares outstanding and get an intrinsic value of $67.69, about $7 higher than the current trading price of the company. Now, as we can see, the free cash flow of BHP has been growing very well over the past 10 years. And even though I stayed very conservative with the growth rate and the initial growth rate number, we still got a very decent intrinsic value compared to the current price of BHP. Now we can move to the third valuation model, where we compare BHP to companies which operate in the same sector, in this case Rio, Anglo, and Teck Resources. We take these companies' current stock prices and divide by their current earnings per share to get their price to earnings ratios. We then average out those PE ratios and multiply by the earnings per share of BHP. And this gives us an intrinsic value of $97.82. And what this means is that BHP is potentially undervalued to companies which operate in the same sector and have similar structures. Now moving to our final valuation model, the dividend discount model, we take the dividend payout of the past 5 years and calculate the average growth rate to be sitting at 24.14%. I then project a growth rate of 3% over the next many years, and using the WACC of the company, we get an intrinsic value of $210.40. Now this might seem as a very high intrinsic value for a company that is currently trading at $60. And that is because we forgot to plug in the yearly dividend frequency, which for BHP is sitting at 2, as BHP only pays out its dividends 2 times a year. Now when we plugged in the dividend frequency of 2, we get an intrinsic value of $105.20, which means that BHP really pays out a very decent dividend compared to their current trading price. Now to wrap up the video, we move to our ultimate valuation. Here we average out the Graham's formula, multiples valuation, discounted cash flow valuation, and the alternative dividend discount model. Not the alternative one, we take the dividend discount model, and we arrive at an ultimate intrinsic value of $83.60, which is a 37.28% upside. If we look back to the stock screener, that is very similar to the analyst target price of $82. Now if we plug in a margin of safety of say 15%, the margin of safety I like to go with, we get an acceptable buy price at $71.06. If we plug in a margin of safety of 25%, that would still be buy price at $62.70. With this, I hope you enjoyed the video. If you'd like to download these spreadsheets, you can do so at my Patreon at the link in the description. Don't forget to leave a like, consider subscribing, and I will see you next time.